This masterclass is to make you a master of trading. If you want to become a jack of charts, indicators, or candlestick patterns, this class is not for you. We focus on what truly matters. Here's what you'll learn in this masterclass: the basics of stock market trading and how markets work, using AI to analyze stocks, hedging strategies to manage risks and boost profits, mastering entry, exit, and trailing stop loss with AI. By the end, you'll have all the tools to trade confidently like a pro. No need to subscribe our channel or like the video. Just focus, learn, and become a great trader. Trading is the art of buying stocks at a lower price and selling them at a higher price. It's a skill that combines strategy, timing, and discipline, and with the right tools, anyone can master it. Did you know that 90% of traders make losses? Learn why. Stock prices are random events, yet most traders rely on tips and predictions for their trading, often leading to losses. No single chart pattern or indicator strategy can reliably predict future price movements. Success in trading comes from mastering hedging strategies to manage risks. Trading is not a get-rich-quick method. It's a disciplined journey to build consistent income and sustainable wealth over time. Intraday trading involves buying and selling stocks within the same trading day. This course is exclusively focused on intraday trading. To start trading, you need a demat account with a broker to hold and trade stocks. In this course, we'll be using a Zerodha account to demonstrate all the concepts and strategies effectively. Before we dive into how to pick a stock for trading, let's first understand the basics of the different position types and order types. A long position is when we buy a stock at price X and sell it within the same day at price X plus P, where P represents the profit. The goal is to take advantage of a price increase during the trading session. A short position is when we sell a stock at price X and buy it back within the same day at price XP, where P represents the profit. The goal is to take advantage of a price decrease during the trading session. A market order for a long position is when you buy a stock at the current market price. This type of order ensures that your trade is executed immediately at the best available price in the market. A market order for a short position is when you sell a stock at the current market price. A limit order for a long position is when you set a specific price at which you want to buy a stock. The order will only execute if the stock's price drops to or below your specified limit price, ensuring you don't pay more than you're willing to. A limit order for a short position is when you set a specific price at which you want to sell a stock. The order will only execute if the stock's price rises to or above your specified limit price, ensuring you sell at a price you're comfortable with. Let's understand a stop-loss order for a long position with an example. Suppose you buy a stock at 100 rupees and set a stop-loss order with a trigger price of 95 rupees. This means if the stock price drops to 95 rupees, the stop-loss order is triggered and your stock is sold automatically at the market price around 95 rupees. This protects you from further losses if the stock price continues to fall, ensuring you limit your risk to 5 rupees per share in this case. Let's understand a stop-loss order for a short position with an example. Suppose you sell a stock at 100 rupees and set a stop-loss order with a trigger price of 105 rupees. This means if the stock price rises to 105 rupees, the stop-loss order is triggered and your stock is bought back automatically at the market price around 105 rupees. This protects you from further losses if the stock price continues to rise, ensuring you limit your risk to 5 rupees per share in this case. Hedging is a risk management strategy used to protect your investments from potential losses due to unfavorable market movements. Taking a hedge position is crucial for preventing losses and allowing traders to safeguard their capital. Before we delve into hedging, let's first understand position sizing. Let's break down position sizing with an example. Imagine you have 1000 rupees in capital and are comfortable risking 1% per trade, which is 10 rupees, 1% of 1000 rupees. The stock price is 100 rupees, and for long position, you set a stop loss at 95 rupees. This means your risk per share is 5 rupees, 100 rupees minus 95 rupees. To calculate how many shares you can buy while staying within your risk limit, use this formula. Quantity equal risk per trade divided by risk per share equal 10 rupees divided by 5 rupees equal 2 shares. So, you can purchase 2 shares, ensuring you manage your risk effectively while safeguarding your capital. Let's break down position sizing with an example for a short position. Imagine you have 1000 rupees in capital and are comfortable risking 1% per trade, which is 10 rupees, 1% of 1000 rupees. The stock price is 100 rupees, and for a short position, you set a stop loss at 105 rupees. This means your risk per share is 5 rupees, 105 rupees minus 100 rupees. To calculate how many shares you can sell while staying within your risk limit, use this formula. Quantity equal risk per trade divided by risk per share equal 10 rupees divided by 5 rupees equal 2 shares. So, you can short 2 shares, ensuring you manage your risk effectively while safeguarding your capital. Let's use an example to understand hedging in trading. Imagine you take 4 trades in a day, each with a capital of 10,000 rupees. For every trade, you set your risk at 1%, meaning you're willing to lose 100 rupees if the trade goes against you. At the same time, you aim for a reward of 2% or 200 rupees if the trade goes in your favor. Now, let's factor in a 50% success rate. Out of 4 trades, statistically, 2 trades are likely to hit your stop loss, resulting in a total loss of 200 rupees. The other 2 trades are likely to hit your target, giving you a total profit of 400 rupees. Net profit equal to total profit minus total loss equals 200 rupees. This example highlights the importance of balancing risk and reward. But where does hedging come in? Hedging is about adding an extra layer of protection. For instance, if one of your trades starts moving against you significantly, you can use a hedge to offset some of that loss. This could mean taking an opposite position in a correlated stock or using tools like options. By incorporating hedging, you can reduce the impact of a bad trade, ensuring that even on less successful days, your capital remains intact for future opportunities. To hedge effectively, it's essential to plan your parameters carefully. Here's what you need to define. Capital per trade. Determine how much capital you will allocate to each trade. Example, 10,000 rupees per trade. Risk per trade. Set the percentage of capital you are willing to risk on a single trade. Example, 1% risk, 100 rupees per trade. Reward per trade. Define your target profit for each trade as a percentage of your capital. Example, 2% reward, meaning 200 rupees per trade for 10,000 rupees capital. Number of trades per day. Decide how many trades you will take in a day to maintain consistency and control risk. Example, 4 trades per day. Additionally, traders should focus on frequent trades rather than long-term investments. The shorter the trading period, the better it is for active hedging strategies. High frequency of trades allows you to take advantage of smaller price movements and improves the efficiency of your hedging techniques, ensuring better risk management and faster returns. To optimize your trading strategy, vary your trades based on stock price trends. Take long positions in an uptrend by buying at support and selling at resistance. Take short positions in a downtrend by selling at resistance and buying back at support. Scalp trades in range-bound movements to profit from small price fluctuations. This variation helps you adapt to different price patterns and maximize trading opportunities. To pick a trade for hedging, visit takoy.paramount.com in your browser. Create personalized watch lists of the stocks you want to trade. You can create up to 10 watch lists, each with a maximum of 50 instruments, allowing you to monitor up to 500 stocks. Human eyes and brain cannot process and calculate such vast data quickly and accurately. That's why we leverage artificial intelligence and stochastic calculus to analyze these stocks and identify the best trades for effective hedging. Let AI handle the complexity while you focus on executing your strategy. Go to the home screen to view the TACO events for the stocks in your watch list. Check the time of the event. It should be recently created within the last 5 minutes. Avoid hedging based on older events, as they may no longer be relevant. Pick different events based on the stock's price trend, such as uptrend, downtrend, or range-bound movements. Additionally, ensure the trade has a good R multiple for a favorable risk-to-reward ratio. To dive deeper into the mathematics behind TACO analysis, watch our previous video linked in the description below. Click on the hedge icon located on the TACO event card to quickly enter a hedge position. This streamlined process allows you to take action on relevant events efficiently and effectively. Enter your capital and risk tolerance to calculate the quantity for the hedge position. This ensures your trade aligns with your risk management strategy and helps maintain control over potential losses. A hedge position is created with 3 key components: the entry price, stop loss, and quantity. These parameters ensure a well-defined trade that aligns with your risk and reward strategy. Open your broker's app to place the order on the exchange. In this example, we are using the Zerodha Kite app. Search for the instrument you want to trade, then click Buy to take a long position. Click Sell to take a short position. Enter the quantity and set the stop loss price. Finally, place the order to execute your trade. This ensures your trade is well structured and aligned with your risk management strategy. If the stock moves in a profitable direction, trail your stop loss to lock in profits. To learn how to implement a trailing stop loss strategy, refer to our previous video link in the description. If the stop loss is not triggered, exit the trade at the close of the trading session to manage risk and stay disciplined. You can also track the profit and loss of the trade against the current market price directly in the TACO hedge position screen to monitor your performance in real time. Exciting announcement! We are thrilled to announce the launch of our crypto exchange for crypto trading starting after January 1st, 2025. As part of this launch, we're introducing a special airdrop for our users. TACO users will receive native crypto coins proportional to their hedge capital. Don't miss this opportunity. Stay tuned for updates and get ready to take your trading to the next level.